weakening U.S. jobs market hits center of Fed rate policy debate. The debate within the Federal Reserve over interest rate policy has intensified following weaker-than-expected U.S. jobs data for July. The Labor Department reported that non-farm payrolls increased by just 73,000 jobs, significantly below forecasts, and revised downward the job growth figures for May and June. This has fueled a divide among Fed officials, with some advocating for a rate cut to stimulate the economy, and others urging caution due to ongoing inflation concerns. Governors Christopher Waller and Michelle Bowman dissented from the Fed's decision to maintain the interest rate target range at between 4.25% and 4.5%. They argued that the inflation impact from President Trump's tariffs is likely temporary, and that the Fed should prioritize addressing potential risks to the job market. In contrast, other officials, such as Cleveland Fed President Beth Hammack and Atlanta Fed President Raphael Bostic, believe the labor market remains relatively stable, despite the recent data, and that the Fed should proceed with caution. The situation is further complicated by Trump's announcement of additional tariffs, which could exacerbate inflation pressures. The mixed signals from the Fed and the evolving economic landscape have led to increased market speculation about potential rate cuts in the coming months. This internal debate highlights the Fed's challenge in balancing its dual mandate of maintaining price stability and promoting maximum employment. With the economy showing signs of slowing growth and the job market facing potential risks, the Fed's next policy move is closely watched by investors and policymakers alike. Fed Governors Waller and Bowman. Why they dissented on interest rates. The Fed's interest rate conundrum, a recipe for labor market disaster? August 1, 2025 at 8 a.m. EDT. Updated on August 1, 2025 at 9:01 a.m. EDT. In a bold move, Federal Reserve Governors Christopher Waller and Michelle Bowman have sounded the alarm, warning that the central bank's reluctance to lower interest rates could have devastating consequences for the labor market. By choosing to hold the benchmark rate steady for the fifth consecutive time, the Fed may be playing with fire, and these two dissenting voices are not afraid to speak out. Waller and Bowman, who voted against the Fed's decision, are advocating for a quarter-point reduction in interest rates. In separate statements released on Friday, they laid out their compelling arguments, both highlighting the ominous signs of labor market weakness that cannot be ignored. But here's where it gets controversial. By prioritizing inflation control over labor market stability, is the Fed taking a gamble that could ultimately backfire? Waller and Bowman seem to think so, and their dissenting voices are a stark reminder that the Fed's decisions have far-reaching consequences that affect us all. And this is the part most people miss. The labor market is not just a numbers game. It's about real people's lives, their livelihoods, and their futures. By holding interest rates steady, the Fed may be inadvertently exacerbating the very problems it's trying to solve. So what's the right call here? Should the Fed prioritize inflation control or labor market stability? We want to hear from you. Do you agree with Waller and Bowman's dissenting views? Or do you think the Fed made the right decision? Share your thoughts in the comments below. Fed Governors Bowman and Waller explain their dissents why waiting to cut rates threatens economy. Imagine a scenario where the economy is on the brink of a downturn and the central bank is faced with a critical decision: to cut interest rates or hold steady. This is precisely the situation that two Federal Reserve officials, Governors Christopher Waller and Michelle Bowman, found themselves in recently. In a surprising move, they voted against holding a key interest rate in place, citing concerns that waiting to ease policy could threaten the economy. But here's where it gets interesting. Their decision sparked a heated debate about the best course of action for the Fed, with some arguing that cutting rates too quickly could lead to inflation, while others believe that it's necessary to prevent a recession. And this is the part most people miss: the fact that the Fed's decision is not just about economics, but also about politics. As Trump appointees, Waller and Bowman's dissenting votes have been seen by some as a challenge to the president's criticism of the Fed. But what do their statements really mean, and how do they reflect the complexities of the current economic landscape? To understand their perspective, let's take a closer look at their arguments. Both Waller and Bowman believe that the tariffs imposed by President Trump have had only a temporary impact on inflation, and that the economy is facing more significant risks if the Fed doesn't act soon. They're not advocating for drastic cuts, but rather a gradual reduction in interest rates to stimulate growth. Waller, for example, suggests cutting rates by as much as 1.5 percentage points, but at a slow pace that allows the committee to monitor the effects of policy easing. Bowman, on the other hand, emphasizes the need for gradual cuts, citing the limited impact of tariffs on prices and the risk of delaying action, which could lead to a deterioration in the labor market and slower economic growth. But here's the controversy. Their views are not shared by everyone, including President Trump, who has been vocal in his criticism of the Fed for not cutting rates more aggressively. In a recent Truth Social post, he even went so far as to call Chair Jerome Powell a stubborn moron for not substantially lowering interest rates. So, what do you think? Should the Fed prioritize cutting interest rates to stimulate growth, or is it better to wait and see how the economy develops? Do you agree with Waller and Bowman's assessment of the situation, or do you think they're being too cautious? Let us know in the comments. As we consider these questions, it's essential to remember that the Fed's decision is not just about economics, but also about the delicate balance between growth, inflation, and employment. The stakes are high, and the consequences of getting it wrong could be severe. So, let's dive deeper into the debate and explore the different perspectives on this critical issue. One thing is certain. The Fed's decision will have far-reaching implications for the economy, and it's crucial that we understand the reasoning behind it. By examining the statements from Waller and Bowman, we can gain a better understanding of the complexities involved and the challenges faced by the Fed in making its decision. Ultimately, the question remains, what is the best course of action for the Fed, and how will it impact the economy? Only time will tell. But one thing is clear, the debate is far from over, and we can expect to see more twists and turns in the coming months.